Hi, and welcome to the November 3rd, being recorded on November 4th, Election Day issue of the Tucson Mortgage Weekly. I'm Todd Abelson. Thank you very much for tuning in. We're getting a lot of questions about what's really going on that's causing all the volatility we're seeing in the bond market. Well, in order to best answer that, let's rewind to last week and take a look and see what things occurred. First of all, the announcement was that the Feds had actually closed off and ended the quantitative easing buying program. And as it stands, they had 4.5 trillion, that's with a T, $4.5 trillion on the balance sheet of various bonds and mortgage-backed securities that they've been purchasing for the last several years. Now, of that 4.5 trillion, there's approximately $1.7 trillion of mortgage-backed securities. That's one of the reasons that interest rates have been kept low, because the Feds are buying it, the prices are staying up, interest rates are staying down. So everybody's kind of wondering, well, what happens now that the Fed's not buying anymore? And that's a key point. They're not buying new, but they're not selling any of the holdings that they have, because that would really be problematic. Not only aren't they buying, but they're now flooding the market with what they have in their inventory, which is going to force prices down and rates up. But the second thing is that they are actually going to be buying, and what they're going to be doing is they're going to be reinvesting money back into new mortgage-backed securities as interest, and B, prepayments occur. So realistically, they'll be continuing to buy, and doing some rough calculations, the Feds are receiving something on the area of about $68 billion a year in interest income from the bonds, the mortgage-backed securities they already have, about $30 billion in principal repayment, and about $30 billion in actual payoffs. So realistically, there's another $10 billion a month the Feds are going to be able to reinvest. Now, that's a long way from the $80 billion that they had been buying, but hey, it's at least something. So the big question with that is, what's actually going to happen? Is the private market going to step up and continue buying mortgage-backed securities? Okay, that's taking the place of the government, and that's really the big key, because if private industry and private enterprise doesn't start buying mortgage-backed securities in a big way, that's one thing that would cause interest rates to go up. Okay, the second thing that could cause interest rates to go up is inflation. Now, the Feds actually corrected themselves last week, and as much as they had been saying, well, we don't expect inflation to exceed 2%, blah, 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 I mean, that's a pretty silly statement to make, because realistically, 2% is the goal, but ultimately, what they've said is they expect it to remain below 2%, but not for a long time. So when, in fact, inflation does start to exceed 2%, again, we could see interest rates increasing. And then the third leg of that really big stool that we've got there is called the labor market. Now, right now, what's going on is, as much as market is recovering, they're saying that there's a real underutilization of the labor market. In other words, that's what they call slack. Okay, what's available and how many people are actually working. And so what happens is, as there's slack, it actually reduces or diminishes what the employees are actually doing. So what ends up happening is, as the slack is taken up, as they're expecting, as the employment increases, there's going to be pressure on payrolls to increase. So there's another leg of inflation. So the end of Q3, the inflation, and the labor market is really the big items that they're looking for. Okay, now let's fast forward to this week. Well, what's happening this week? Well, the ADP and the employment report's coming out. So as of Friday, there's going to be the big report telling us what's really going on in the labor market. Now, right now, they're expecting something in the area of 240,000 new jobs to be created. That would be a pretty darn strong number. So right now, the markets are really focused on, well, what's the job report going to be? Other things going on is Europe is not doing so good, and things like that. But right now, all eyes are on the employment report. So if we get a really strong employment report, that would signify that the slack is going away, and we could be seeing some wage increase pressure coming into 2015. Anyway, so bottom line, keep an eye open for Friday's report. Keep an eye open for the stock market. And you'll get an idea of what's happening. Interest rates are going to go the opposite way. So good employment information means rising interest rates as well. Okay, don't forget to check out the blog site, TucsonMortgages.com. I'm Todd Abelson. Make it a profitable week, and hang on, it's going to be wild. Bye.